And hi there, investors. It's Martin, it's Nick, and today we're going to do a bit of a walkthrough with Manchester real estate, but the higher end real estate. So this would be over £300,000 up to probably around £500,000. So the plan is to have a look at the areas of interest, then look at some of the calculations, see how they work out, and from there you can draw some of your own conclusions as to whether you think it's interesting. And if you do, maybe you should be buying some of that higher end real estate for yourself. The next thing I'm going to do is share screen, and there we go. All right, what I've done here is set up the system that we've got. As you're probably aware, if you've watched any of our videos, we pull in lots of data, we use lots of data, and we kind of come up with a general picture of capital growth and sort of all sorts of other metrics. But today we're just really going to concentrate on the capital growth story.
Can you zoom in, make the icons a little bit larger?
Okay. There you go. Is that better?
Yeah, better. All right. Maybe we'll watch them from.
What I've done is filtered the data so that we have, I'll just show you, disable that, full screen. We've got a lot of stuff going on here, but that doesn't really help us when we're trying to narrow down into those few areas where the median house price in middle of 2021, I hasten to add, I'm updating the data set very soon, so it'll be to September 21. But anyway, the median house price being over £300,000. So that kind of gives us a general bar, as it were. Median is different from mean, by the way. Mean is average, so it's all the houses sold in the area divided by the number of houses. Median is where you have all the houses in an area sold, and then you pick out the 50th house. Let's say it's 100 houses sold. Then it's the 50th, the midpoint property. And it's very good for property analysis because it gets rid of outliers, because you might find in an area that there was a property sold, like a block of some big fancy house sold for 10 million, and then that raises the whole averages for the area. So this is the way we look at it. Now, if it's got a very dark border, it means that the median house price is relatively high. In this case, it's 583,000. What that means, in effect, is that in probability, you will not find houses for 300 that are nice, for instance, or they would be the cheapest houses in the best area, which isn't necessarily a good thing. It's only a good thing if the cheapest house in the best area is a fundamentally good house. But that aside, now I'll put Martin over there so you can see him looking away, doing his thing. Now, let's just reinstate that filter so we can get rid of some of the noise, and then we can kind of zero into those areas that seem to be in that kind of 350 or 300 plus zone. Now, the first thing is when you zoom right out, I'm going to zoom out now. I'll zoom back in a minute, but I just want to show you the overall patterns because I think that helps you understand the geography. And I'll just hide the postcode district boundary so you can see a little bit better. And maybe I'll do the dark road map so it helps you just get your bearings as to where the action is, because this is all we're doing really. Now we can see
postal data, so the circles data.
Yeah, yeah. What I'll do is I'll hide that, but I'll show you postcode district so you can just get your bearings on where things are, because you know, postcode districts, we all think about them. Okay, now we've got a rough idea of where the action is. It's mostly in the south. So if I zoom further out, which I will, if we look at it on a really kind of macro level, it's all here. Now, why would it be here? Now, my guess is, well, I actually have a couple of reasons why I think this. One is historic. So the prevailing wind in the UK comes from the west or the southwest. And in London and in most cities in England, which emerged during the Industrial Revolution, what happened was the clean wind came from the west, the dirty wind came here. So guess what? The richer people would live where the air was cleaner, and the poorer people would live where the air was not so good. So that's one reason. And the other reason is because of the airport. So wealthier people are more international.
Yeah, and from there is a station from London as well, for a train.
Yeah, well, it's a very good point. So you've got better connectivity all around, flight and otherwise. So this is why the action is all down in the southwest corner of Manchester. So now we've got that sorted out. The next question is which areas within the southwest of Manchester are most interesting? And for that, I'm going to zoom out again, and we're just going to have a good old look around. It's not good enough to say, oh, the southwest is the best. What one has to then look at is which bits of the southwest are best for capital growth. Now, generally speaking, in these kind of areas, the richer areas tend to have less capital growth than the poorer areas at this point in the property cycle. So this is where I just go do a little bit of a backgrounder on this. Sorry if you've seen this all before, but I'll be really quick. Markets go in cycles. This is 1845. This is today. We've had 9 distinct cycles. If you include this teeny little peak here, just during the war, that's number 10. And in a cycle, this is the cycle. The cycle in a cycle, you get a crash, then everything goes terribly wrong, and everyone says the world is over. And then you get a steady recovery, you get a correction. So this is 2008. This correction was 2017-ish. And then you get the boom phase, which is generally 4 years, 3-4 years long. So if we look at this chart, which is a really good way of understanding the duration of booms and the duration and the extent of them, then this chart is wonderful. So this looks at mortgage costs as a percentage of take-home pay. Now the thing is, in the 90s, I'll make it bigger so you can see it. In the 90s, interest rates, so interest rates are the green lines here, interest rates were actually quite high relative to now, so sort of hovering 8-9%. Property prices were lower, but what really matters is affordability. And this is why I love that other chart, because it just gets rid of all the noise around interest rates being high or low, whatever. It just looks at affordability. And the same story here in 2008. We had interest rates hovering around 4 or 5%, and then we've had low interest rates. I'm going to get into the historic stuff in a minute when we look at predictions on interest rates. But my point is that we're now entering a phase where affordability is decreasing. So this is up to 2021. We know that people start to go a bit nuts. So if we look at the historic, we can say that a typical property cycle is going to last, say, the intense phase, should I say, will last 3 years, 3 to 4 years. Now, the question is, are we going to get a repeat of this? Well, no, because interest rates went from very high to relatively lower, and we don't have any room for declining interest rates. So therefore, I expect the way it's going to play out is we get a big spike, and it'll be a bit like in the 90s. Big spike, 3 years of madness, then it'll settle down. So the thing with 1990 was the plug was pulled by the government because they rose interest rates dramatically, and it went from affordable to ridiculous in a very short period of time. And that's what kind of did everyone in. And there were lots of repossessions, and it was just a bad time. I know, I remember living through it. Fortunately, I wasn't caught up in it. I was too young to have a property back then, but I got involved in a bit of real estate speculation after that in the down period, where I just knew there was value, and there was. So what do I think is going to happen next? Well, I think we have to go back to the Second World War, really. And we have to use, or we don't have to, but we should use public debt as a backdrop. Why? Because governments don't like to hurt themselves. If the government raises interest rates to, say, 4%, for example, to combat inflation, what they'll do is they'll raise the cost of servicing their public debt by probably 6 times, 6 times. So if we say base interest rates of 4.75%, you go up to 4%, then it's like a 5-fold increase in debt maintenance costs. What does that mean? Well, government has to find the money from somewhere. Where does it? Well, it has to raise taxes. It doesn't want to do that. So if you look at historic precedents and you go back to First World War, you see the government debt in the UK was very high, spiked during the war, Second World War, and then gradually there was a diminishing of debt. So we then look at interest rates and we look at that story as a backdrop, and you can see that you basically had high interest rates all the way during this period here, right up to the 70s. And guess what? As public debt diminished as a percentage of GDP, up went interest rates, because debt was basically privatized at that point. So that the rule is that the government don't nuke themselves by doing high interest rates whilst they have huge public debt. And the way they get rid of public debt is inflation. Sustained inflation over a long period of time erodes the cost of public debt. And when it's finally under control, if there's a boom, but low public debt as a percentage of GDP, that's when you fear high interest rates. So my prediction is that we're going to have relatively low interest rates probably for another 5 years, 8 years minimum. The prediction from Ray Dalio is that interest rates will go up to maximum 2.5% in order to combat inflation. But any more than that, it becomes unsustainable for governments to maintain that debt cost. Again, we go back in time to look forward in time. Think about the period between 1930. So 1930 is a very good example, actually, because you had the booming 20s, you had crazy inflation during the war, and really we're in a similar position with a combination of paying for COVID and Brexit, which is causing massive long-term turmoil to this country and forcing inflation because it restricts immigration, and immigrants are generally the answer to inflation when it comes to wages and so on, because they expect less high wages than UK people and such. All right, so that's the backstory into interest rates, where it's kind of going and so on. Now, the next thing we should look at, I think, is some real estate. Let's have a look at real estate. So with that in mind, I'm going to just skim through a few properties that are kind of at this price point. It doesn't matter if they're sold or not. We're not really looking at that. We're just looking at what you can buy. Now, I know that the market is really hot. So these kind of properties, the way the agents play this all out is they'll market them at a slightly lower price, get a whole load of interest, and then try and bid the price up in a bidding war. But you can see, you get yourself a 1,400 square foot house, very nice. And we'll have a look at the floor plan. We don't have square footage, but if I go here, duplicate this. So this is just property data. It's quite helpful, gives us a sense of what's going on. You can't see the pictures. We have property, we have Rightmove Plus, which we're going to look at in a minute, on Martin's side. So he has all of that. And I'm just going to do a quick comparables. And oops, I want sold price comparables. And we go WA, we go the same area as the rental one, which is WA15, and we just have a radius around that. And we're going to go semi-detached, radius 3 miles, leasehold. We'll go freehold because you know what, we're going premium here. And we need, we'll go with that. All right, so what I'm looking at is really the cost per square foot and just some general idea of that. So we're talking average for £400, 450, I would say,
500.
generally speaking. So I'll just pick out properties more recently sold because I think that's more helpful. And when it eventually does it, come on.
Look, if you go back.
Yeah. And all right, I'll just do this again.
Better.
So we'll go sale date up to 6 months ago, radius 3 miles, and we'll go minimum property price 350,000, I think we'll go. And that'll help. So let's have a look. Semi-detached, because I think detached at this price point, you'll get detached, but
Yeah,
so we can see that it's probably 450 average, I would say, based on this. This is just a very rough approximation. But these properties, they're going to be a classic kind of big semi-detached house, 1,000 square feet, 1,300 square feet, that kind of money in a good area. So that's kind of what you're in for these kind of properties. But the question that leads me to ask is, what about the capital growth? Well, typically the growth is going to be found where there's value. And there's value in kind of mid-sized houses where people are trading down to, or they're obviously trading up to. And you can see in this area around Timperley, for example, there's some good growth. At this price point, I would say satisfactory growth would be, say, 11% over 3 years. This is inflation adjusted, by the way, very important. And I always do this because real wealth gain is gain above the rate of inflation. And that's it. And if you think of it's otherwise, then that's not real wealth gain because you've got to factor inflation, right? So it's just one of those things. So there's this whole idea of purchasing power and so on. But the upshot is this area is strong, WA 15. And so I think the objective around here is to find standard houses that are probably, okay, what I would be doing around here is looking for median priced houses. So those 350, 400,000 pound houses, not the big mansions, because actually that's not the same market. The good thing about these kind of areas is you have a mix of nice semi-Ds and big mansions, and that's okay. So it's okay to have the cheapest house in this kind of area because the cheapest house is still a really good area. What's not okay is buying a worker's cottage next to a mansion. That doesn't actually work. So you're looking at high-end demographics. The demographics have to have AB above probably 30%. That'll be fine. And you're avoiding areas with high proportion of so here's a good example, in fact. So if the housing stock is really good around here and there's a reasonable mix, then that kind of gets interesting. But the issue is that you've got these nice houses here, and then you've got the poor neighbors nearby, and that's not going to work. So this terrace of your houses here, this just would not do.
Terrace bungalow, so they're not the best one.
Yeah, you just wouldn't touch those. They're inferior. They're just so far below the average that you wouldn't look at them. The other issue is that if you're buying really expensive houses, you've got a very small market. That's dangerous as well, because then you've got a thin market and you have to hang around a long time to get a buyer. And that's basically a risk. So you would not necessarily do that. So the rule of thumb is find property where the median house price is X, and then you can you got a bigger market, a bigger addressable market. Therefore, you got more liquidity, which is safer, obviously, because lack of liquidity is dangerous. And then you'll be in a good place. Now, Martin, can I go over to you and can you share a screen and we can talk about it?
I'll show my screen now. Yeah. So basically, I will talk about because what I did, I used WA15 postal and use 5 miles, and this is the property like for renting, and this is only 4 bedrooms. Detached house.
Just to explain, the reason we're doing this is because as buy-to-let investors, everything comes back to the yield.
Yeah.
And then you have supplemental issues like, for example, stamp duty and so on. So what we're going to do is just look at some properties that are interesting, pick some out. So Martin is the lead analyst in the business and he deals with this all the time. So he knows what good looks like. We're going to pick out a couple of specimen properties, kind of work out what would that cost to buy, what would the rentals be, and then we're going to run some calculations and draw some general conclusions within the next 10 minutes or so we don't run the video too long. Okay, let's go.
So this is like...
that's a classic 1970s house that's been tidied up a bit.
Like 12, and it will sell for 450, I guess, now. So that will give you 4.5 yield. Okay. Not the best, but...
So what we'll do is just kind of get a benchmark on what the rentals would typically be, what the purchase is, and then we'll run through the calculations in more detail, because I think that there's so many weird things going on, because you can say that's the gross yield and it's X, but actually you've got to pay more stamp duty. You've got to pay more fees because the fees are all based on percentages of the rental and so on. And that's why we have to be.
This property was sold for 6K and the rent to 10. So
yeah, but then today's money, that's 700, isn't it?
Let's assume this. So that's 4.2. So basically the yield will be, I guess, from 3.8 to 4.8, depends. The yield will not be great because while you were talking, I was analyzing this as well. So because this is 40, now it's 50 at least, so 185.
Now the thing to remember in these higher end markets,
5.5.
You don't get so much capital growth because the yields are just not there. So therefore there's less investor interest. But if you think of it like this, if you think about the hassle factor, then if you have fewer houses, sink more money into fewer houses, then you've got fewer rental issues and you've got a better class of tenant in theory, and therefore it's better investment from a hassle point of view. But from a net cash return point of view, it's not so good, which we'll see in a minute. And I know that calculations get a bit boring for people, so we'll try and keep it entertaining. But anyway, let's pick a house at, say, the 400 mark, because I think that's more helpful.
Yeah, so I would go with semi-detached.
Yeah, I think it and I think it is semi-detached at this price point. I think that's where the value is as well.
I'll go for 3.25 to 4.5.
Yeah, that's good.
So you can see like 3 bedrooms. This is like now for me, for this price range. This is nice house.
Yeah, this is good value. This looks like a nice property. So this would be how many square feet with this, or meters? It's probably 1250, I would have thought, or like say 110 meters.
It doesn't really have.
Yeah,
but
that's
it's
okay.
Yeah,
well, you can judge it. I mean, to me, it looks like 1250.
Yeah,
it's got the big extension room, the big extension, and so on.
This also nice. Looks not the best, but it's nice.
Yeah, well, that's classic 70s, that one.
Yeah, it's not. I guess it's 900. It's small.
Yeah, it's a bit compact, but then that's the thing, you're paying for the location in these kind of areas.
Yeah. So this is 1,000.
Yeah.
400.
The thing about space, it's got to be said, is that it's not good enough to have more space. It's got to be usable space. And people often kind of make that mistake and they just go, oh, it's huge, I'll have it. But huge and unusable, absolute waste of money. So what we're always interested in is just well-designed space. And if you think that if you make it like an equation, the equation would be, if you have well-designed space, then it's worth for 1 extra square meter of good usable space, it's worth 1.2 square meters of not so good space, if that makes any sense. So therefore, I would happily take 1,000 square foot usable, well-designed house than a 1,250 or 1,300 square foot property with less effectively set out space.
Yeah,
but I think like for these kind of so for these kind of properties, 800 is just getting a little on the small side, I would say, for that kind of price point. What's your opinion, Martin?
Yeah, I think in this price point, the yield will not be the best, but the capital growth will be nice. So and you will have tenants; they will not destroy the house. For example, if you buy cheaper property, you have more risk to have bad tenants.
So I've done quite a lot of analysis on this, on the relationship between capital growth. So we'll just stop share screen and we'll just quickly recap on this. Then we get into the next bit, which is the calculations. Okay. So yeah, if you stop sharing screen, and I'll.
So I just was checking like for 150, 12, approximately 375. So 4.8 yield, which is great, I guess, for this price range.
Yeah, this feels about right to me as well. We're going to go into the calculations in a minute, but okay. So to recap, the best area in Manchester at this price point is definitely southeast. Yeah. And there are certain little patches around Hale Barnes, Altrincham, where you've got huge houses, and then you've got these very solid, very reasonable semi-detached houses, like tracts of them. They are good. I haven't done much like on the ground research on these properties, so I don't know what the demand is like, but I expect it's huge, because the reason I know this is because we have data to tell us these things. And I'll just quickly show you the demand numbers here, and then we'll get into the next thing, which is calculations. So I'm just breaking it up into the most boring stuff at the end for most people, because that way then you know, if you've had enough, you've had enough, kind of thing. But you know what, smart investors know it's all in the numbers. All right, so if we look at WA15, for example, which is a key area, so this whole patch is really the zone, I think.
Yeah.
And we can see turnover sale 27% a month, so it's a hot area. Without boring you with all the details, it's massive rental demand, massive sales demand. It's as hot as any of these kind of patches. Now, if I go out here, this is probably, the turnover is probably lower here because you got the big houses, and therefore there's less liquidity. So what we're interested in is the median priced houses for these areas, I would say, where there is high turnover, and then it's just a question of competing. Now, this is another good example, but the prices aren't, it's not the right kind of demographic and so on. And let's have a look here. So this could be interesting as well. Very good demographics in certain patches. So as a strategy for buying in these kind of areas, the way I would do it is spread across various places, but concentrate on one general patch. But you can see here, this is interesting, good demographics. One would need to be looking at areas where AB is over 30%. I think that would be a sensible thing. And where all the fundamentals are good and capital growth is somewhere above, say, 10% over the last 3 years. Absolutely.
Yeah. I will add it as 25% of AB, and I will like to not have more than 10% of social house around.
Yeah. But you can see in these big areas that the demand is there. So this is the important thing to remember. It's a very hot, fluid market. It's just a price point up. Now, I want to just quickly do some calculations. So we're going to just do a specimen property. We're going to go 4-bed semi-D because I think these properties are big enough. If you think about your typical rent, what would you get on average for
Well, for 4-bedroom semi-detached house, 150.
So you mean 1,500 a month?
Yeah.
And what would you expect to pay for one of those?
Yeah,
On average?
40,000, 300. Yeah,
How
that's
much?
good. Yeah,
400.
it's good.
Okay.
400.
So that means our gross rent, gross yield is 4.3%, and
You need to bid like 10%. So let's add the asking price. No, I mean the agreed price for 20.
Okay, does that mean you'd rent it for 1,500?
Yeah.
Okay, that messes up the yield a bit, but let's have a look at that. All right, and therefore we have a problem right now because we can't get a 75% loan to value at that rent. So we have to go down a little bit. And this is where this starts to be problematic. So in fact, we probably have to get down to say 65%. So I'm just going to go 1,550 because it doesn't really
achieve.
So now we have the problem where we can't get the loan to value. And this is the whole thing about the calculations, why smart people always look at their numbers. So the catch with this is that we don't have the yield, therefore we have to go lower loan to value. And if we have to do that, then we're in a troublesome place. Why? Because the cost of purchasing the property goes right up. So it's a 49% we have to put 200 grand down on a 400 and something £1,000 property. That just is not attractive if you're doing buy to let. Now, if you're happy to get a low average return on your property, fine, but this is not a good place to be. There's a whole lot of detail here around total net cash return. So what you're assuming, of course, is that you're going to get growth. And if we look at the capital growth numbers for this area, we can see that even though we put 200 grand down, because the cost of ownership and so on is so high, then we get no cash return. So then we're into just capital growth. What do we do at it? How does that work out? Well, if you look at that number, let's say, just as a very rough approximation, capital growth in WA15 has been pretty solid, and but there are other areas which are better than it. But okay, that's fine. So let's have a look at how this looks in the future. So let's assume neutral growth. So in other words, let's be conservative about this. Then you get a £100,000 growth, which means in the future, that's fine. It's worth, you bought it for 420, you sell it for 553, cool. So nominally you do well, but of course you have to factor in inflation and you're not doing so well. So you're 25 grand up. And really, with your money, you'd be far better off going down the food chain and buying a property for, say, 220,000. So let's just do that. £220,000 property, Martin. What would you expect on a rental for that?
Let's say 1,050. Depends. But the asking price, yeah, you need to pay 240. So
okay,
for 1,000, you can 240, 1,000.
So for that's the ratio. So that's fine. And therefore, our gross yield is 5%. And
this is like approximation. It's not the correct.
Yeah,
sometimes
I know. So it's just
depends where.
Yeah, exactly. It's an illustration. So okay, we can get our 70. We can go up to 75% LTV. Yay, because we've got this. Then where are we at? So we said 440 for the other house, the other fancy house, and the cost of purchase is down to 33%. And so I'm dropping 81 grand. So if I multiply that by 2, that's £160,000 for. So what I'm going to do is, because we're looking at this higher price point, I'm just going to do an illustration here. We're going to go 440, and then I'm going to go 2,000 and 2,100. Why? Because I want to just do an equivalent yield, which is, whoops, 2100, sorry. Equivalent yield, 5.4%. So that's fine. Okay, so we're talking equivalent. So I just want to go, what if a £440,000 property yielded the same as a 220 property? 34%, so we're in the right zone. So then you just have to drop 150 grand. So you're dropping less cash out. That's good. And let's look at the return. For your net cash return, you're getting an ROI of 6.15%. So you're actually getting some money back. Great. And you're getting a £1,500 net cash return. That's all nice, but it's really about the capital growth. And if we look at the capital growth numbers, then you're actually making the same kind of growth, aren't you? Because growth is equal. So what we're looking for is so you make more net cash return, but you have the same growth. That makes sense. So then the equation becomes finding areas with better growth and getting more net cash return whilst getting more growth. That's the equation. So with these kind of properties, I think you would just say, go for these areas here. So M33, for example, will have higher overall growth than WA15. And if you're prepared to put more cash out proportionately, then you do that. So I'll just finally recap on this. So we say that you would get 1,500 rent on a 440 property. You've got lower yield. You've got to have a lower LTV. So the lower LTV needs to be 60%, which we've now done. So therefore, instead of putting 150 grand down, you've got to put 216 down. Your money is working 25% less hard because you got to put 25% more down per property, and you're making a borderline net cash return because you're spending less money on interest, so that's a good thing. And where's the net cash return? Yeah, and you're making borderline net cash return. So you're losing a little bit of money just kind of holding. So ultimately, these kind of houses are essentially a store of wealth, and that's about it. You get some capital gain. So the smart way to deal with this is, if you don't want the hassle, but you just want to park money, then these houses will do. Just be careful where you buy them so that you maximize on capital gain, and then you got yourself a nice asset which you can cash in before the market crashes, basically. Martin, any final comments from you?
Yeah, these properties works as well. I guess you will have less competition than the property who have like cheaper price, especially because not a lot of buy-to-let investors want this kind of price. So
yeah, so in theory there should be less competition, but I think we don't know for sure. We have done some investigations, and there is competition, of course, but it's not the same kind of madness. The characteristics change, basically. You tend to get more viewings booked in, and as I say, just more people trying to park money, or they just want to upsize. So it's still crazy competitive, and good properties will be ridiculously competitive. It's just how that works. Anyway, all right. I hope you found that helpful. Manchester is the place to buy, I think, at this price point. If I was going up another level, I don't know, I might look at other places, but it's becoming Britain's second great city, in my view, and promises to keep growing. And those kind of houses, to give you a comparison, in London, nice semi-detached in good condition like that will sell for £1 million in a nice prime area. So there it is. All right.
Yep.
Plenty of headroom. But remember, property cycles. Okay, investors, thank you very much for that. And until next time, good investing.
Good investing.